The markets have opened, and if you blinked, you missed the most violent volatility we have seen in years. For 48 hours, the world was bracing for a major global escalation. We were bracing for $150 oil, we were bracing for $100 silver, and for exactly 15 minutes on Sunday night, we got it. But then, the narrative shattered. The market looked at the Operation Epic Fury headlines, looked at the statement from President Trump, and decided that this war might already be over before it even fully began. Let's look at the tape, because the price action is absolute insanity. When the Globex futures market opened at 6 p.m. Eastern, silver gapped up vertically. It opened at $96.40. Gold gapped up to $5,393. Crude oil surged nearly 12% to hit $75 a barrel. It looked like the extreme volatility trade was on, but then the selling started, and it was relentless. Within minutes, oil erased nearly 70% of its gains, crashing back below $70. Silver plunged from $96 down to $92.90. Gold gave back $60. Stock futures, which opened down 1%, stabilized. The S&P 500 is down less than 1%. Palantir is actually up 4%. Why is the market fading the war? Why, with burning ships in the Strait of Hormuz and a military command in Tehran, are traders selling oil? Because of one specific statement from the White House. President Trump just provided details on the operation that changed the algorithmic calculus instantly. He stated that the U.S. claims the entire Iranian military command is gone. He called on the Iranian people to seize this moment. The market interprets this as a swift operation rather than a prolonged regional conflict. The algorithms are calculating that with the leadership gone, the war will be short. They are speculating that the Strait of Hormuz will not be closed for months, but perhaps just for days. And if the war is short, the war premium evaporates. This is a classic buy the rumor, sell the news event. The rumor of war drove silver to $94 on Friday. The news of the actual strike drove it to $96 on Sunday. But the realization that it might be a one-and-done operation caused the smart money to take profits immediately. However, we must be incredibly careful here. The chart for silver right now is broken. Traders are reporting gaps that defy logic. We saw the price gap up to 96.4, gap down to 92.9, gap back up to 94.7. This is not a liquid market. This is a market with no depth. The bid and the ask are miles apart. Those holding high-risk positions during this open likely faced massive forced exits in both directions. And while the paper market is selling the news, the physical reality remains dangerous. Oil traders might be selling futures contracts, but Maersk has still suspended shipping. Insurance companies are still canceling policies. There's a massive divergence right now between the paper confidence that the war is over and the physical reality that the tankers are still stopped. If the market is wrong, if the retaliation escalates, then this fade in oil and silver is a massive bear trap. In the next part of this deep dive, we are going to analyze the Trump doctrine and why Palantir is up 4% while the rest of the market is red. We are going to look at the specific wording of seize this moment. Is the market pricing in a friendly new regime in Iran that pumps more oil? That is the only logical explanation for oil crashing back to $69. But is that realistic? Or is it wishful thinking? While the missiles are still flying, the market has made a decision. It has decided that Operation Epic Fury is not the start of World War III. It has decided that we are witnessing a fundamental shift in the regional power structure. But the price action confirms it. Crude oil opened up 12%, screaming blockade, but within minutes it collapsed back to a 3% gain, whispering victory. Why? Because of the specific language coming from the White House. President Trump stated that the entire Iranian military command is gone. He explicitly called on the Iranian people to seize this moment. This is not the language of a limited strike. This is not the language of deterrence. This is the language of regime change. The algorithms that trade global macro events are programmed to look for key phrases. When they see command is gone, they interpret it as conflict duration short. They interpret it as a decapitation strike that removes the ability of the enemy to coordinate a prolonged war. If the leadership is gone, who orders the Strait of Hormuz closed? Who orders the mining of the Persian Gulf? The market is pricing in a scenario where the chain of command is no longer functional. And if nobody gives the order, the oil flows. And if the oil flows, the inflation spike is canceled. That is why oil crashed from $75 back to $69 in the blink of an eye. It is pricing in a scenario where a new, potentially pro-Western government emerges in Tehran, and Iranian oil actually floods onto the market rather than being taken off. But look at where the money is going. While oil sold off, Palantir stock rose 4% in overnight trading. Why Palantir? Because Palantir is the operating system of modern warfare. It is the AI that powers the targeting, the logistics, and the intelligence analysis for the U.S. military and its allies. The speed of these developments serves as a significant case study for the effectiveness of modern AI-driven defense systems. The market is valuing advanced defense technology while discounting the long-term risks of instability. It is saying the U.S. military tech is so superior that this conflict won't last long enough to hurt the S&P 500. However, we must be incredibly cautious with this narrative. Markets are often wrong in the fog of war. Remember transitory inflation? Remember 2 weeks to flatten the curve? The market loves a clean narrative, but war is messy. Reports from the region indicate a total vacuum in the highest levels of leadership. The Strait of Hormuz has burning ships in it. Maersk has suspended shipping. Insurance companies have canceled policies. Even if the command structure is gone, the chaos remains. Local militias, rogue IRGC units, and regional proxies like the Houthis can still cause massive disruption. They can still launch missiles at tankers. They can still target infrastructure in Saudi Arabia or the UAE. So, while the paper market is celebrating a quick victory, the physical market remains in extreme danger. This divergence creates a whipsaw risk for anyone trading silver or gold. We saw silver gap up to $96.40. Then it crashed to $92.90. Then it bounced back to $94.70. This is not a trend. This is liquidation. This is extreme volatility causing rapid exits from the market on both sides. As the narrative shifts from war to peace and back again in milliseconds, the chart for silver right now looks broken because liquidity is broken. There are no real buyers or sellers at these levels, only algorithms chasing headlines. In the next part of this deep dive, we are going to look at the physical reality check. While the futures market fades the war, what are the physical dealers doing? We know Thailand halted trading. We know Chinese shadow markets were bidding gold at $6,000. Will they lower their bids because Trump tweeted? Or will they continue to favor physical assets over digital contracts during this period of uncertainty? We will also look at the massive gap in the oil chart. If oil fills that gap and goes negative, the deflationary bust could be the next surprise. We have to stop looking at the headlines for a moment and look at the market structure itself. Because what we are witnessing on the charts right now is not normal price discovery. It is a broken market. Traders with decades of experience are looking at the silver chart tonight and saying, I have never seen anything like this. We saw a gap up to $96.40 on the open. Then, in a vacuum of liquidity, it gapped down to $92.90. Then, just as violently, it gapped back up to $94.70. This is not a trend. This is a heart attack. It signals that there is zero depth in the order book. The market makers have pulled their bids and asks because the volatility is too high to model. When you see gaps like this, $3 up, $3 down in minutes, it means the paper market is broken. It means you cannot get in or out of a position without massive slippage. But the most terrifying disconnect is not on the silver chart. It is the gap between the futures market and the physical reality. Right now, the algorithms trading crude oil futures have erased nearly 70% of the war premium. They pushed oil back down below $70 because they believe the regime change narrative. They believe the war is effectively over because the command structure is gone. But tell that to the captain of a Maersk tanker. Tell that to the insurance underwriter in London. And while the futures market celebrates, Maersk has not resumed shipping. The stand-down order is still in effect. The insurance cancellations are still active. The burning ships, the Skylight and the MKD Vayan, are still burning. This is a massive divergence. The paper world is pricing in peace. The physical world is pricing in a blockade. You cannot ship oil with a Trump tweet. You cannot insure a cargo with an algorithm. Until Maersk announces that ships are moving again, the physical supply of oil is effectively zero for that 20% of global capacity. If the ships don't move by tomorrow, the futures market is going to have a very rude awakening. The realization will hit that regime change does not equal safe passage. Chaos on the ground, rogue militias, leaderless armies, can be just as dangerous to a tanker as a coordinated state military. If one more ship is hit tomorrow, the victory fade in oil will reverse instantly, and oil will rip back to $80 or higher. This brings us back to silver. Silver is caught in the crossfire. It gapped up on the fear of inflation from an oil shock. It sold off on the hope of a quick resolution. But the underlying fundamental driver, the safe haven status, remains. Gold is holding up much better than oil. Gold opened at $5,393 and is holding gains of nearly 2%. It is refusing to sell off. Why? Because gold knows that even if the war ends quickly, the geopolitical landscape has changed forever. The taboo of targeting high-level strategic infrastructure is gone. The boundaries of regional conflict have been permanently reset. The risk premium for the next decade just went up, and silver, being the high beta cousin of gold, will eventually follow. The The volatility we see in the paper contracts is a distraction. The true value is being found in the physical metal, where there is no debt and no counterparty risk. This is where the real wealth is moving. We also have to consider the Monday morning margin call. When the regular session opens, we expect extreme volatility. As the S&P 500 faces pressure, many investors will be forced to liquidate their physical holdings just to maintain their accounts. This isn't about the value of gold. It's a desperate scramble for liquidity. So do not trust the price action you see right now. It is a mirage created by low liquidity and high frequency trading algorithms. The real price is determined by two things. 1. Does the oil start moving through the Strait of Hormuz? 2. Do the physical dealers in Thailand and China reopen their trading windows? Until those two things happen, we are flying blind. In the next part of this deep dive, we are going to look at the Asian Open. We are moving into the heart of the Asian trading session. Will China buy this dip? Will they see silver drop from 96 to 93 and say, thank you? We know they were bidding $6,000 for gold in the dark pools. If they step in and buy this fade, the price could rip back to the highs before New York wakes up. We will also look at the palantir signal again. If tech stocks hold up, it confirms the market believes the US military tech just won the war. But if tech starts to roll over, it means the fear is spreading. We are now moving into the Asian trading session. It is Monday morning in Shanghai, Tokyo, and Mumbai, and the traders waking up in the East are looking at a very confusing picture. They went to sleep with news of surgical leadership strikes and maritime conflict. They wake up to find US futures pricing in a victory lap. They see oil crashing back to $69. They see silver fading from $96 back to $93. And they have a decision to make. Do they believe the Western algorithms that say the war is over? Or do they believe their own eyes looking at the Strait of Hormuz? Here is the war room assessment of the Asian Open. We believe China and India will treat this fade as a massive buying opportunity. Remember the data from the weekend. Chinese dark pools were bidding gold at $6,000. They were panicked. Now, the futures market is offering them gold at $5,330. That is a nearly $700 discount from the panic price. The data suggests a strong preference for accumulating physical holdings over selling. They will use the current market liquidity to increase their physical metal reserves. The Chinese know that structural political shifts are complex. They know that a leaderless Iran is just as dangerous to their oil supply as a stable Iran. So watch the price action over the next few hours. If silver finds a floor at $93 and starts grinding higher during the Asian session, it confirms that the physical buyers are stepping in to absorb the paper selling. We also have to look closer at the palantir signal. We mentioned that palantir stock is up 4% while the rest of the market is red. This is not just a stock move, it is a geopolitical statement. The market is pricing in the era of the cyborg war. It is betting that US military technology, driven by AI and real-time data analysis, is so superior that it can decapitate a hostile regime in a single night without triggering a prolonged world war. It is the Gulf War moment for the AI age. In 1991, the market crashed before Desert Storm, then ripped higher when they saw smart bombs working on CNN. Today, the market is betting that Palantir and US drones have done the same thing to Iran. If this narrative holds, we could see a massive rally in defense tech and cybersecurity stocks on Monday. It becomes a war tech boom. However, this narrative has a fatal flaw. It assumes the enemy will follow the script. It assumes that because the command is gone, the retaliation will stop. But decentralized militias, the Houthis, Hezbollah, the various IRGC factions, do not need a central command to launch a strike at energy infrastructure. They have autonomy, they have stockpiles, and they have anger. If one rogue commander launches a swarm of drones at a Saudi oil field tomorrow, the Palantir narrative collapses. The victory fade in oil reverses instantly, and the price of silver rips back to $96 and beyond. The market is pricing in perfection, but war is the opposite of perfection. So for the traders watching the Asian session right now, do not get lulled to sleep by the drop in volatility. The VIX might be pulling back, but the Strait is still closed. The peace trade is a paper tiger. The physical trade is waiting for the next ship to burn. If you are in India watching the Nifty open or looking at MCX gold prices, understand that the rupee price of gold is going to be sticky. It won't drop as fast as the dollar price because the local demand is real. The arbitrage window is still open. In the final part of this deep dive, we are going to synthesize all of this into a clear Monday morning action plan. We will analyze the key levels the market is watching on the S&P 500. If the stock market crashes on the open, despite the victory narrative, it means the contagion is spreading. We will also give you the final word on silver. Is $96 the peak, or is there further upside potential toward triple digits? This brings us to the end game for this historic weekend update. It is Monday morning here in India. The sun has risen over Mumbai, and the financial markets are waking up to a world that has fundamentally changed in the last 48 hours. We have seen Operation Epic Fury launch 900 strikes. We have seen the confirmed death of the Iranian supreme leader. We have seen the Strait of Hormuz effectively closed by insurance cancellations. And we have seen the U.S. president declare that the command is gone, triggering a massive sell the news event in global futures. Now, as the MCX, multi-commodity exchange, prepares to open its doors, and as the Nifty and Sensex brace for volatility, we need to synthesize all of this chaos into a clear strategic outlook. The Sunday night gap saw physical and spot-linked prices surge. Silver reached $96, and oil touched $75. But the fade, the collapse back to $93 and $69, tells us that the paper market is betting on a swift end to the conflict. They are betting on a miracle victory. But in the war room, we do not bet on miracles. We bet on data. And the data says the risk is far from over. Here is the war room action plan for the week ahead. Point number 1, respect the head fake. The crash in oil prices from plus 12% to plus 3% is a massive head fake. It is based entirely on the assumption that because the leader is dead, the war is over. But Maersk has not resumed shipping. The burning ships are still smoking in the Gulf. Until the physical flow of oil resumes, the victory fade is a dangerous trap. If you're watching the oil or silver markets, be extremely careful about trying to bet against this momentum. One headline about a further supply disruption or a retaliatory strike could send oil ripping back to $80 in seconds. The war premium is volatile, not vanished. Point number 2, the Indian opportunity, MCX strategy. For our viewers in India, the setup is unique. The rupee is likely to open weaker against the dollar due to oil fears. This acts as a floor for local gold and silver prices. Even if the global spot price fades, the rupee depreciation keeps the domestic price supported. Furthermore, this dip from the Sunday highs gives Indian mutual funds a second chance. Remember the C-buy mandate we discussed? The funds that need to allocate to precious metals might use this morning's pullback to enter the market. They see gold down from the panic highs and see it as a buying opportunity for the long term. If you are an accumulator of physical metal in India, do not chase the gap up. Let the volatility settle. The structural demand from the C-buy rule change is a marathon, not a sprint. Point number 3, watch the $92 level. On the global silver chart, $92 is now the critical support. We gapped down to 92.90 overnight and bounced. This level must hold. If we break below $92, it means the peace trade is dominating, and we could fill the gap back down to $88. But if we hold $92, even amidst the victory headlines, it confirms that the underlying physical bid is strong. It confirms that the safe haven demand is real, regardless of who is in charge in Tehran. Point number 4, no leverage. I will say it again. This market is broken. We saw gaps of $3 in minutes overnight. Liquidity is non-existent. If you use high leverage, the whipsaw will liquidate you before you can even react. This is a market for owning assets, not renting them. The mining stock paradox will likely be in full effect today. Expect miners to open red as the general stock market sells off. Do not panic. It is a liquidity event, not a solvency event. We are witnessing a regime change in more ways than one. We are seeing regime change in Iran. We are seeing regime change in the global energy market. And we are seeing regime change in the valuation of gold and silver. The volatility is the price of admission to the next era. The era of cheap energy and stable borders is over. The era of hard assets and high volatility has begun. If this deep dive helped you navigate the most dangerous weekend in recent history, please hit the like button. It helps us fight the algorithm and reach more people who need to protect their wealth. And if you haven't already, please subscribe. We will be monitoring the MCX Open, the London Fix, and the US stock market open closely. We will bring you the truth about the money, the metal, and the macro.